So 2026 is almost upon us when I'm recording this. And there's some changes coming to QSBS, but some things aren't changing. And so I was reading through the code the other day and I was like, they had the opportunity to address the marital statuses for community property states, and they haven't yet. And so I want to kind of talk about what we can do if we're married. So I always tell my husband, what's mine is his, and what's his is mine. And whether he agrees with that or not, I'm not exactly sure, but that's the way I see it. And so that's the way the IRS sees it if you're in a community property state. And so the first thing you have to pinpoint is, what are marital assets? And those are the assets that you acquired during your marriage. Those acquired prior to marriage are still yours. Now, that's not to say you opening an account prior to marriage and then you start putting money into it during your marriage wouldn't make that a marital asset. But just saying that I paid off my home, I own my home, that was mine prior to the marriage, that's not considered a marital asset. And so this can include things like homes, investment properties, tangible goods such as cars, bank accounts, retirement accounts, securities, stocks. And so what states does this apply to? And so you're talking about Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, Wisconsin, Alaska, Tennessee, South Dakota, and technically not a state, but a territory, Puerto Rico. And so what does that mean to be a community property state? So all assets acquired during the marriage are considered owned jointly, regardless of your title. So if you put that asset in your name only, doesn't matter those community property states, they say, no, that's a joint asset because you acquired it during your marriage. That's a marital asset. And then they go a step further and they say even earnings are considered half earned by spouses. And that's the same concept with debts, too. And so during divorce, marital assets are split equally. And so how's that different from other states? So other states are called common law states. And property that belongs to a spouse is basically those that have their name on the title. And it doesn't automatically assume that half of it's owned. And so in death, marital assets are divided per the will or probate if there's no will. And then in divorce, they're based on equitable division, whereas the community property state says half and half. So how does this apply to qualified small business stock? So say you have a taxpayer who founded their company. They have 400,000 shares that are issued to them. They're all eligible for QSBS, and their cost basis is less than 1 cent. And so A, our taxpayer, was married to B at the time of issuance. They lived in California, which is community property state, and they reside in California still. And their company was also a California company. So we have a community property state all the way across the board. And so 5 years down the road, that's our holding period that we have to meet. A's company is acquired and they receive $55 million. And so that's for all of their shares, but the shares are still in A's name. And so if you have somebody that's not familiar with community property rules and QSBS, they might just report all of that under A's tax return as theirs and only get a $10 million exclusion. But according to community property rules, B automatically owns 200,000 of those shares that they were issued. And so even though they're still in A's name, it's 50% B's holdings and 50% A's. And so that gets split down the middle. And so you can't just automatically assume I've got A's shares only. And so taxpayer A can claim the $10 million in exclusion, and taxpayer B can also claim the $10 million exclusion because they have two sets. And so how do I get that conclusion based on section 1202, which is what's housing the QSBS exclusion? And so this is specifically under little b, paragraph 3. And the code reads, with separate returns, you can claim $5 million if you're married. But it doesn't say anything about community property states. It doesn't say anything that you have to do it this way. And they had a chance when they were drafting the One Big Beautiful Bill Act to edit this, but they didn't. So we have some guidance and some tax lawyers that we meet with here at KB Advisors that actually will give us opinion letters to say, hey, this is totally legal. This is totally allowed. The code's allowing us to do this. And so all of a sudden, what was a $10 million exclusion is now $20 million exclusion. And so it's totally worth taking the time to really dig into what was I doing at the time of issuance of these shares? Was I married? Was I in a community property state? Where am I residing when I'm liquidating these shares? What does my company look like? Could maybe I get those shares in their name before the acquisition happens to make it look cleaner? So, these are the things that we kind of help facilitate. We dig into all those details to say, do they all line up correctly? And so, like the other day, we had somebody that founded their company in California, and they're a California company, and they resided in there, they were married, and then they moved to Texas. And they're like, oh, shoot, I lost it. But Texas is also a community property state. And so we were like, nope, we think that's okay. And so we'll work with them to basically make sure that they're set up for success to take this $20 million exclusion. And so, not too shabby for a day's work. And it's just really fascinating work that you can do underneath the code sections that we've been given and be totally legal and have a really great day for taxes in terms of not having to pay taxes on $20 million is a great idea, right? So feel free to reach out to us. And then our blog has a whole page for founders. And we kind of dig into other issues that you run into that are really specific to founders. And so it's one of our specialty here at the firm. And we really do enjoy it and love working with the founders. So thank you again. I hope you found it interesting. I find it fascinating, but I'm a tax nerd. So here I am.